Imagine I had...
Episode.
I don't fucking know what the episode... What is the episode?
Episode
52.
Episode 52.
This is a big moment. Where are we? And hello.
Hello.
Where are we? Why are we in this new podcast room without our Invest in You sign? Where are we?
We're in my new house.
Wow.
So we haven't we've set it up, but we are going to be moving probably towards the end of this year again. We're going to get an office. It's going to be a proper podcast room.
Yeah.
So for now, we've set up in my new property where I'm renting.
Shit on. No. No, it's a nice place, Samantha. I promise you, I like the place. Samantha's Frank's partner. It is a nice property. I really like the property. Horrible parking around there, but the home is a lot better. It's very nice.
You like it, huh?
I like it. I think it's beautiful.
Do you want to buy it?
No, I would not want to buy it. Actually, maybe start off there. If I were to buy this shithole, how much would this cost? I can't say shithole. Samantha, I'm joking. How much would this cost if I bought this place?
Oh, good question. Probably around 1.7 to 2 mil.
Okay. How much are you renting it for?
1,000.
There you go. That's a good rental yield, buddy.
Pretty good.
What would that cost you if you bought this property?
Well, if you bought it for 2 mil. Well, if you bought it for 2 mil, depending on what your debt is,
Put a 20% deposit?
Cost you over. You're probably looking over 15 grand a month in repayments.
I'm talking if you had a tenant in there.
Yeah. We mean if you bought
it as an investment.
$1,000 a week.
I know. If you had a tenant in there, how much would it cost having a tenant? $1,000.
As expenses
for the owner of this place. How much would it cost?
You're probably gonna be out of pocket maybe 60 grand, so maybe 50 grand. I got to do numbers, but yeah,
Fuck.
You'll be out of pocket a fair bit.
Yeah. We're talking about I know we've got an actual very good topic that we're talking about today, but just on this, we're talking about this, you, me, and Ryan. Ryan, you and I. I think that's the right terminology. Of like, you can only really buy a few of these properties if you were to go down this route, right? And just go for capital growth, and not think about, our style of investing. I know you really have strong thoughts on it, but
depending on the individual, my old rental property, the owner bought that for 2 mil, 1.9 he bought it for in 2023. I moved in. We were there for nearly 2 years. He went and bought another one at the same time, another property around the corner for like 1.6. And there were his 2 investment properties. I'm not sure if he had other investment properties, but he was head of the Austin Hospital, was high up, and I think his wife was something to do with cardiology, head of or something like that. So they look big income earners.
yeah.
But when you look at that back that other property they paid 1.9 mil, renting out for $870 a week in rent.
Yeah.
Like you look at that, that's if I had to just own that property. Probably with a 20% deposit on that. Actually, yeah, the numbers on that one at 6% or 6.5%, 125 grand a year. So, if you were to buy this, say 2 mil, and you put down a 20%, just doing the numbers now, you're probably going to be out of pocket 30 G's or something like that.
A year.
30, 40 G's.
More, yeah. Anyway, that's not what we're talking about today. What we are talking about today, though, is asset classes. So, you and I are at that period now where we have. We've already got commercial assets in our property. We've got duplexes. We're looking at rooming houses right now. I wanted to do a podcast today for the viewer, for the listener, to almost walk through each different type of asset class. Now, we can't do a fucking 300-page report on every different asset class, but just talking about the different asset classes, when you're getting to different asset classes, pros and cons of getting into different asset classes. That's what I want to talk about today.
Yeah, let's do it. I think every asset has its purpose, and I think when you invest, I think people don't actually have a purpose when buying certain investment properties. If they're a novice, how many clients do we have that go and they buy a townhouse or a unit, and it's not the great investment? And we all made that mistake. We did it ourselves.
Yep.
But there was no purpose behind it. It's like, just get into the market.
Yeah, which is a load of shit, really. But yeah.
Yeah, and so. It's funny, I had a client yesterday, having a chat, we're going over their plan. His name's Val, and he's got a property, a unit in, Liverpool, New South Wales.
New South Wales, yep.
And he goes, it was a good learning curve. It hasn't grown. It's done nothing. I've owned it for, I think, 5 years plus. It hasn't grown at all.
Yep.
But he goes, it was actually good to keep me accountable to actually buy something, get into the market. He goes, back then you're young, partying, going out. It actually stopped me doing that, and actually pull me up. And I go, that's actually a great way to look at it. But he goes, it's not a great property, of course.
Yep.
So Of course, that's a good way of putting it as a purpose of him getting in the market and actually, being responsible, which is fantastic. I think he's 30 years old. I think so. He probably bought it when he was 5 years ago, 25. So that's awesome.
Legend.
But at the same time, hasn't done anything. So we'll talk about starting from the basics. We'll talk about more sophisticated investments, when to get into those investments. I think what I want to talk about is probably the the don'ts
Okay.
first, because that's probably the most important thing. What do you reckon?
Well, so I don't actually agree with you on all apartments are shit, right? Like, yes, I bought an apartment, fucking horrible. Sold it 8 years later for less than what I bought it. You can still buy apartments that are going to get growth. You just need to be very specific about what asset you're buying and how big the complex is and whatnot. So I'm just cautious to say, hey, it's a don't buy apartments if that's all you can afford at the time, right? Like you could buy, I don't know, there'd be apartments in Gold Coast that have absolutely skyrocketed, right, over the last 5-6 years. But I'd be keen to go with that. Let's roll into
awesome.
don'ts.
So I think if you're, and this, once again, this is not personal advice.
This is not financial
And it's not financial advice. This is we're talking really general here.
Speak to your financial whoever. They're fucking all useless anyway. But go.
I guess, depending on your circumstances, okay, this is where it all comes down to. But if you're going to go for an apartment or a unit, okay, they can, like I said, I believe that can be a terrible investment, but it all depends on the location and timing and where it's at.
Yep.
We've purchased units, like semi-duplexes for clients that have a very tough price point, like 250, 280, and they can't go above that.
Yep.
Instead of doing nothing, you can get into a great market in like a regional town where there's actually a low supply of units and apartments. I like to target more units in an apartment. An apartment's more like a high rise, block of 5, 6, 7 stories, and there's multiple dwellings. Units are, ground level. Maybe there might be 2 levels, but nothing too crazy. It's like an 80s build. So they have a bit more growth and a bit more different prospects. So we've purchased those type of properties for clients, and they've actually done quite well. So when getting into investing, if you don't have to go down that route, don't do it. But if you have to, that can be a different option.
Yep.
Looking at a regional town, the property that has different aspects. So for example, some of these units have a nice big courtyard. They got bigger, living areas, dining areas. They got bigger bedrooms. I bought a duplex. The laundry, I don't know, I was with Ryan, and he walked in, he goes, bloody hell, this laundry is huge. He goes, the biggest laundry I've ever seen. It's ginormous. Like just little things like that. And I know that sounds silly, but it's like you've got more room and it's a different asset. But notice that in regional towns, this is the funny thing and what people don't look at. There's not many of those properties around. Yeah. Like you go to Melbourne, Sydney, and you just look at the dwellings or what type of dwellings are in that suburb or in that LGA. Majority of them, of course, will be houses, maybe like 50, 60%, maybe 70% houses. Yep. But then the rest will be like townhouses, units, apartments. Yep. When you go to a regional town, like 90% of the properties, 95% of them are houses. Yep. Okay, but not many units, not many, like very rarely apartments, of course. So when you buy something like that, it's actually quite scarce. Yep. So there is actually growth, and we've purchased properties for clients at 250, 280, even lower than that.
Ante, I think was one.
And it's actually done well.
Ginormous,
yeah, I think it grew by like 40, 50 grand. So like in the space of 1 year, which is great for a unit, and something that he paid, I think 300 grand, or I think less than 300 grand. Yeah. I think it was like in the high twos. Bought another one for Randy in WA for 280. And I think that's worth around 350 today, and that's been 12 months. Like it's done quite well. Like it happened, you can do that, and it happens all the time. There's great growth in those type of assets. So I look at this as a do-don't sort of asset, and it just all depends on your circumstances.
Cool.
Okay.
Cool. I think the biggest thing though, and probably more important, it's the region that is the most important, right? And it's the actual that is going to do the heavy lifting of the growth, especially in these. I mean, land is the thing that's going to grow an asset. Excuse me. But most importantly, 70-80% of the heavy lifting is going to be about the due diligence on the area. All assets in that area are going to grow regardless.
Of course. And you see it around Melbourne, Sydney, when the market was doing quite well, and we've seen it in areas that we're buying in, the market's doing really, really well and growing. Everything's growing.
Of course.
So that's something to take in consideration. But the stability, and like you said, the land is what is the value part. We can do more things with it. Land is king, and you can develop and do all sorts of things. That's the most important part. But like you said as well, like if you're in the right market cycle, everything's going to do quite well, regardless if it's a townhouse, apartment, or a unit or a house.
Yep.
They'll all do pretty well at the same time.
Awesome. Love it. Okay. So anything under 400K, we're essentially saying townhouses, apartments, units, that's there. I guess now from where we really help our clients, like from like 400 to that 600 price point, what are we looking at? What's the asset class? And when should you be getting into this next asset class, which is obviously houses?
So yes, houses is probably where you want to try and start off.
Yep.
High growth.
Yep.
I think majority of people that get into property need growth because they might have a deposit just for one property and that's it.
Yep.
So to come up with more properties or buy more properties, you need a deposit. And the way you generate that is by a property growing in value and then taking out the equity. So houses is what it's our bread and butter for our clients. What we look at is probably 600 plus square meters of land. Sometimes we go, a little, you might buy the odd one at 480, 500, depending on the client and what we're looking for as well. But roughly 600 plus. You're looking at a nice house, 3 bedroom, 2 bath, or 1 bath, or 2 bath, 2 car garage or 1 car garage. Even a 4 bedroom or 5 bedroom doesn't really matter. Sometimes we've purchased a 2 bedroom house. And they're quite cool as well, like because they're very affordable, much more affordable than the 3 bedrooms. And if you got once again, you got to climb for a tough price point. Going for something like that's awesome because you got land as well, and
for sure
you can still do something with the property. So you start with that, and the reason why you would want to start with that is you buy those type of properties, you accumulate them, maybe 3, 4, 5 of them, depending on everyone's circumstances, and you hold those assets. You let them grow, you let them appreciate. And how you get into all those assets is you buy one house, let the equity grow. Release the equity, go again, buy another one, rinse and repeat. But you get to a certain point where you need a certain amount of properties to get you to kind of your goal and what you're trying to chase.
Yep.
And then those type of properties, of course, that produce that growth. Of course, cash flow is quite important too. Of course, you don't want to be reliant on your income to support the portfolio, but during times where interest rates are high, of course, that's important also. So interest rates do affect that, but as well, rental yields are quite important as well. So we normally try to hover around. When we first started this business, what we were doing 6-7% rental yields
easy
on houses. Now you're looking at 4 to 5. You might get the odd one at 6, but that's very, very rare.
Yep.
So it's around that 4 to 5%, which is still quite healthy.
It's a lot better than this shithole.
Yeah. Well, if you bought this house and you paid $2 million and it rents out
2% rental yield.
I got to do numbers something like that. So it's something to look at as well. Make sure that property there is not going to, affect you too much as well.
Yeah. But, I'm always cautious to say, like, it's not going to affect you. Because there's 2 ways to look at that, right? So I absolutely agree, right? The most important phase, buy 3, 4, however many properties you can hold, right? Let's say you can hold 3 properties. Each one's costing you 10 to 15K a year out of pocket before tax. So what's that? 40 grand a year for 3 properties. If you can hold those assets, 40K out of pocket for 5, 6, 7 years, you can turn those 3 assets, that 3, 5, 600K assets into $1 million, 1.2 each, give or take, try and double the portfolio over a 5, 6, 7 year period. That is then when you move into the next phase, right? So I'm cautious to say, it can't let it affect your lifestyle. It has to affect your lifestyle, right?
Yes, but of course you'll be silly if you were saying, okay, let's just go buy a property in Melbourne, and instead of buying something at 500 or 400 that's got a 4 or 5% rental yield, you go out there and you buy something that's got a 3 or 2%.
100%, yeah.
You got a property, then you got one property and it's costing you, what it should be costing you for 4 properties.
1,000%.
That there is a silly thing to think about or do. So you do need to be cautious too and not let it too much affect your lifestyle. Because of course, where I'm coming from is, yes, it's going to affect you. You're going to have negative cash flow right now, but you don't want to put yourself at a risk also.
Of course. And I'm not saying buying an asset like this $2 million asset, renting for $1,000, right? Because that's 40 grand in itself. I'm talking if you're buying 3, 4 assets, the portfolio is costing you $30,000, $40,000. Let's say you're saving 60 grand a year, 70 grand a year. As long as you're still being able to put food on the table, as long as you're still able to kind of manage that, once you sell off, or when we get into the next stage, when you talk about that, you need to withstand a negative portfolio. If you're not able to withstand a negative portfolio, especially now, obviously rates continue to go down, great, is what it is. But if you can't withstand that, you probably go for something else. Don't go for established properties. Do not go down the route of buying established. Go for growth, selling it down, and then moving into the next asset class. That's all I'm saying. Whether it's a 40K a property costs you a year, one property, or whether it's 15K, you need to be able to go, okay, cool, I'm getting into this over a 10-year period. I'm going to turn this negative portfolio into a cash cow or whatever it have to be. But anyway, cool. So houses, from there, what's the plan? What are other asset class which are going to be bringing in more cash flow? The asset class that you and I are now looking into.
Yeah. So look, I think from there, you got a whole bunch of other options. So I think what we'll go next with is looking at duplexes and blocks of units, so multi-dwellings. I like multi-dwellings because they're safe. You can buy a duplex or block of units. One tenant leaves, you still got something coming in.
For sure.
And you still have the growth component. So when you look at apartments or units, of course, the growth can be quite stagnant during times.
Yep.
But when you're buying a whole block and you own the whole land and there's no body corp, you are the body corp. They're quite attractive as well, from not just from owning the land, but from a cash flow perspective too. So you've got the growth and they've got the cash flow coming in.
Yep.
So we've gone down that route. You know, you've got a duplex. I've got a duplex. We've bought blocks of units for clients. I've bought a block of units for my mum.
Triplex.
You know, and those type of properties are awesome because, like I said, you got multiple rents coming in. Someone leaves, you get something coming in. And that cash flow on them, you can manufacture it too. So for example, I bought one just recently, paid $550, renting out for $560 a week in rent. I'm going to do carpet, paint, and a little bit of other extra works around the house. That's going to increase the rental yield from $560 to $740, $750 per week.
That's going to. You can do this with every property, but you're just saying because you're doing it with the duplex, you're getting the benefit of both assets.
Both, and then the rental yield is going to be a lot higher. It's going to be over a 7% rental yield.
Love it.
So 7% rental yield in today's market, especially in Victoria, is a very, very healthy rental yield, especially when you got in Vic, the rates, the insurances are a lot cheaper than Queensland.
Yep.
You get a 7% rental yield in Queensland versus Vic, the Victorian property is going to be returning a lot higher.
Because just say that one more time. Sorry, this asset's in Victoria, the one that you've just purchased, the duplex.
Yep.
And just say that last part again.
So if you compare a 7% rental yield in Queensland versus Victoria, the one in Victoria is going to have a higher return. So you're going to make more money per year.
Yep.
Because in Queensland, your rates are probably double what Vic is.
Yep.
Your insurances are double what Vic is. And your property management fees are probably 2 or 3% higher than Vic.
Yep.
So you know the utilities are a lot cheaper. So if you can manufacture that in a multi-dwelling, okay, that's a great way to get into an asset like that. Or if you can just buy one that's already buy, set and forget, it's a great way to not have too much negative cash flow. And that's where we're being a little bit more strategic now, where we can go for houses. Yeah, you get your 5 or your 4% rental yield, but it's still going to cost you money to hold it. Where with this property, I've taken out equity, I've bought this property. This property is actually making me money now.
Yeah.
Every single year.
Yep.
So once I do those works, okay, it's probably going to cost me about 10 grand, 15 grand to do those works. I'm not doing nothing too crazy. That 15 grand plus the equity release plus, of getting the loan on that property, it's actually going to be cash flow positive still.
Love it.
So, not by much, but I'm still it's better than being in arrears, but I still got a growth asset as well and I've got cash flow.
So very important here, right? Because it's now our stage of the portfolio where we're moving into different classes, and I guess going out and buying assets that are costing us 10, 15K, which is just our established homes, 500K properties, renting for 480, 500, 450 even. Have you made that decision to now buy a duplex? And I know this answer, but have you made the decision to do that because the portfolio is now costing you too much? And you're like, well, shit, now I need to buy an asset that's not going to cost me? Like, what is it?
Yeah, yes and no. I was looking at a few different options. I was looking at that option there, a duplex.
Yep.
And I was also looking at buying a property and then being able to put a granny flat on the property.
Yep.
So, and that's where I think the next asset class I want to go with is granny flat. But that's what I was looking at because I wanted to just stop having too much negative cash flow at the moment. I've got a few properties that are cash flow positive, but I've got a few as well that are negative. So my portfolio overall is negative. So that's something I'm cautious about too.
Yep.
And I just want to look at ways of how I can start to change that so I can actually borrow more money and then still, get more property.
Cool. So what would be the difference? Because if I can talk about my Bundaberg property, right? I've had the same. My property's done 120% growth in the last 4 years, and the property's at like a 11% rental yield, right? Over 10% rental yield. Purchased it for.
But when you say that, is that because of when you purchased it, or is that because of purchase price and what the rents have gone up to?
Correct. What the rents have gone up to, right? So if you were to buy the property today, the property would cost 850, the rent at 960, right? So it's probably 7% give or take today.
No, probably be around over 6%.
Over 6%, right? So like that's what it would be today if you buy it. I bought it for $412,000, right? When people hear that, people go, well, fuck, why should I be even going down the established route versus why should I go down the duplex route or the quadplex route or the triplex route? I guess that's probably a bad example because that's had an unimaginable amount of growth in that period. Is that the same for all duplexes, all like multi-dwelling assets?
Oh, of course. It definitely it is. Of course, it just depends on the market timing and where you're at. So, yeah, they all follow that same trend. Because once again, you own the whole block. Gotcha. And with them as well, you can actually do some crafty things. And this is getting a little bit more technical, but if you buy a block of units and there's no strata on them and they haven't been strated so you can put a body corp on them and then sell them off individually, you can get an engineer and a town planner to go through that property and get up the spec and then strata them. Once you strata them, the value of the property actually increases. Because if you look at it, I'll give you an example. I bought the property, the duplex for $550. Mm-hmm. In that area, you can buy units for $300,000 plus. Okay, that are that nice units that have been of course they look a little bit better than mine internally. So if I strated my property, got up the spec, then I was able to sell it, or if not, leave them, keep them, but then order a valuation. The valuation will come in higher.
Yep.
So this is where now blocks of units become a little bit more appealing, and you're like, oh, okay, this is I never heard about this. I can strata it, increase the value. Now, strataing, it can cost you $5,000, it can cost you $50,000.
Yep.
It depends on the property, depends on what you have to put in. Sometimes you got to put firewalls in and all sorts of things in place because if it's a really old duplex or a really old block of unit, normally it's not going to be up to code, to current code. Mm-hmm. So you might have to do some modifications. But it's a great way to I know we were talking about your current property that you had in Bundaberg, looking at doing that also, and the value increased dramatically.
Yep.
So. These are little things and little hacks that you can do with the portfolio.
Yeah, love it. Okay, so then just to the viewer, why go down the route of getting an established standalone property as opposed to just a duplex?
Because look, it's not easy to find a duplex these days. If you go back 5 years ago when we started the business, you could find so many in Queensland, WA, and all over Australia. Very easy. Now today it's very hard, and the returns aren't always there as well. So I look at it as, let's say I was going to buy this duplex I bought.
Yep.
If I was only going to get a 5.6% rental yield or 5.5, whatever it was when I first purchased it, and that's it, and I couldn't increase the rent and the rent's already at maximum price and value of what the current market's dictating, then it wouldn't make sense. Like I would look at it and go, okay, well, I'm not going to get probably a significant amount of growth compared to a house in that current market.
Okay.
And the reason why, yes, they grow, and we say they're a growth asset, but the houses will push up a lot more because it does appeal to the owner occupier.
Gotcha. Yep.
So going into them and too early sometimes can be great, but it also can be catastrophic.
Yep.
But no, it's not easy to find as well. Like if I could find duplexes for every client, we'll be buying a lot of duplexes for a lot of clients.
But they're just not around.
They're just not around.
Yeah.
So it's very hard and difficult too. So if that was our if that was our own focus, a niche, and saying we focus only on finding duplexes, we wouldn't have a business.
Okay, that's a fair point. Yeah, because there's just not enough.
No, there's not enough. There's not enough at all.
Okay.
It's so hard to find them. So it's just it all, and I guess with, like I said, going back to your traditional houses, there is still things that you can do to it. So the next point I want to talk about is granny flats.
Yeah.
Yep. If you buy a house with a nice big backyard, side access, you can put a granny flat on that property. That there is going to, you can increase that rental yield pretty significantly.
Absolutely.
Probably more than what a block of unit could do.
Yep, that's interesting.
You look at your property, you got that property in Bundaberg, it's a duplex.
1,500 square meters.
Yeah, 1,500 square meter block. What are you, like you're doing something like that now at the moment? You're looking into putting a granny flat? And
Correct.
What's the return and what's that going to look like?
200K, turnkey, $350 to $400 a week.
So 200K to build, you're saying?
To build the whole thing, the entire service, build the whole thing, which I mean, I think you could get it for a bit cheaper, right? Probably 150,
course.
160.
Of course.
I don't know if we're actually going to do it because there's no side access and the block size is a bit weird. So it's like you need to be super careful about this. You need to make sure that the person living in the granny flat's not going to be walking past, you know, the people living in the duplex or people living in the house. So that, like, you need to be careful with that just from a resale and just a tenantable perspective. Like, does someone really want to be co-living with someone and that kind of being in each other's shit? No, not really. But if it was, and if we do go ahead with it, it's 200 grand, it's $400 a week in rent. What's that? That's you know the numbers.
Probably, yeah, that's a high return. It's over 7%, I think.
So like it's huge, right? And that's going to, I mean, the property's already bought the asset for 412K. It's renting for 960. Throw another 400 on that. That brings it to 1360 on a $600,000. I mean, all up the amount of debt that I have on that 600K and $1,300 worth of rent. I don't know the fucking yield off my head, but it's already generating me, you know, a lot of money already as it is. So if I could have added the granny flat in there, I think it would be awesome. I just don't think I'm going to do it.
Yeah.
Yeah.
And that's just because of the access of the block and not
Correct. Yeah.
Yeah.
Even though it's on a
Makes sense.
1,500 square meter block.
Yeah, because your property's it's like built on a diamond.
Diagonal. Yeah.
It's like a
weird thing.
It's a weird block. So
looking out for that as well, though. Like if the strategy is we're going to buy this asset, we're going to let it grow, and then at the period 5, 6, let's add a granny flat on there. Looking out for an asset or a block size, it's like, okay, cool, we're going to be able to do that. I think is awesome.
of course, and there's rules around it too. So like for example, in Vic, all you need to do is add a granny flat. You need 10 meters of back door, or you say where the house is from the back door to the fence, 10 meters. You need as minimum, and you need 1 meter access on the side. That's it. So you don't need to be able to drive a car through there. I know in Queensland, from my understanding, you need to get a car down the side of the property for access. So there's a little bit more different rules and regulations. And if you build up to a certain size in Queensland, you don't have to get a building permit.
Correct.
Same with Victoria as well. I think it's 50 square meters I forgot what it was in Queensland, 50 square meters or lower.
I couldn't tell you exactly.
And so with that you know, like you said, you buy a house, you can do that granny flat onto the property. It's something you don't do straight away unless you got the income or you got the equity or you got the financing to do something like that. It can even be that you buy a house that doesn't have the opportunity to do something like that, but then sell that house after 3 to 5 years. It's done its dash. Okay, you maybe have left over 300-400 grand after the sale. You take that, buy a house that you can add a granny flat, but then you have the cash to build the granny flat. And a property like that, like you said, there's other types of granny flats you can put on, modular homes. They cost 40 grand.
Yeah.
They ship it to your house. They crane it onto your house. It's like a container and it opens up. About 42 square meters. 42 square meters of living. I think 1 or 2 bedrooms. Just buy, set and forget. Of course, you got to pay for you got to get the plumbing. You got to get electrical. You got to get. You probably have to get some landscaping done.
Not turnkey.
Not turnkey. So you probably might look at 80 grand. Turnkey.
Yep.
But the rental yield on something like that can be like a 12 to 15%.
Yeah.
Because it might not rent out as well as a purpose built, which is the one you're doing or looking into.
Yep.
The 200 grand that's built from scratch down, from slab to ceiling, where this is a little bit different. So they don't return as well, as in like the rental yield won't be $400 per week. It might be like $200 a week.
Yep. But still,
the rental yield,
investment,
is ginormous. And a property like that will be cash flow positive straight away.
Yeah, and this is where we get creative. Again, we're talking about something else here, but you buy a property, you sell the property, you take 400K, you put that into an asset, which at a granny flat, that's positive. We're talking about what structure you buy that in so you can continue borrowing. There's that's where like being super strategic actually starts opening up. But
you look at granny flats, there's no extra rates.
Nothing.
Utilities, you might get extra utilities if you put water meters on them. So like the utilities for the water might go up. PM fees, of course, go up because the rent goes up. But insurance shouldn't go up that much as well. Like it's very minimal costs. So the return is much higher. And so when you start factoring not paying extra rates or the rates don't, increase and all this type of things, like it's going to be quite a great return for the person that does that.
Yep. Love it. Okay, cool. So that's our duplexes. Then obviously we've got blocks, units, triplexes, rooming houses even, which we're starting to look into.
You're looking at buying one right now.
Yeah, we've put an X through it. We've actually decided that we're just going to put an X through it because, so this is interesting, right? We went and visited it last week in Victoria, 9-bedroom rooming house, renting, so 100% tenancy, which obviously you can't go off 100% tenancy. It's $200 a room, so it's $1,800 a week in rent. But I think you've got, I mean, they are still, I mean, my buyer's agent is looking at it right now.
What was the purchase price?
$900,000 asset.
Christ. So what's that? Like 12? Or no, over a 12% rental yield?
1,800. Do the numbers. You got your phone?
No, I haven't got it on me. But that's. But I think so I know you're still speaking with Josh about what this looks like. But with rooming houses, we've looked into it for other clients. I remember in Toowoomba, looking at two around $750, and I think it was renting quite similar, 1,600 or 1,500. What people don't take in consideration is there is a lot of expenses. So
absolutely,
one of my clients, we bought a property for him in Townsville. I actually spoke to the people that turned his house into a granny flat. It's quite interesting. So there's companies out there. You buy a property, it has to be in a certain location. They will convert your house into a granny flat.
10.4%.
There you go, 10.4.
So that's huge.
Yeah.
Sorry to just completely cut you off.
No, it's all good.
What I was saying was more important. No, there you go. Go for it. Sorry.
Yeah, so they convert your house into a granny flat. They might have to put an extra bedroom, or if you want to put an extra bathroom, or you want to do multiple rooms, there's a certain fee.
Yep.
So you paid $30,000, you got an extra bedroom, so you turned it into a 4-bed to a 5-bed. It's renting out for $1,100 a week. This is in Townsville. We paid $400,000 for the house, but insurance is like $6,000.
That's right.
You've got, maintenance is about $2,500 for like just, cleaning, lawns and things like that. He has to pay for Wi-Fi. He has to pay for electricity. Electricity and water can go up through the roof because you got 5-6 people, sometimes more living in there. There's a lot of expenses. And sometimes the insurance can be more than $6,000.
Yeah.
So, and the property management fees on that property, I think it's 15%.
Yeah, it's through the roof. It's
through the
12%. The one that we were looking at, and we're in Vic, right?
Yeah. So when you look at it, he's cash flow positive on a P&I loan. I think it's $3,000 a year.
Yeah.
Which is still great. Like you're still in front, but can it jeopardize the house on growth? Yes, it can, because you're just purely going to, when you sell that property, target an investor. And none of us like to pay overs. Of course, as an investor, we all want to pay, below market value.
Yep.
So you cut out, 70% of the market, which is mum and dad or first home buyers or, people that just want to upgrade
people
their
that drive
family
the
home.
prices up.
Yeah.
Yeah.
Correct.
Yeah. So it's kind of the reason why I don't give a fuck for the resale. I'm more worried about, because these are the assets that I'll probably keep forever, right? Like my duplex. I'm going to keep that asset forever. My houses, I'll flog them off. I'll wait for them to double. I'll flog them off. I'll put them into a rooming house or whatever. The reason why we decided, and we still haven't even actually officially made the decision, he's still doing DD on the asset. The reason why we haven't we're not going ahead with it is because the rental yield actually comes down. Like we worked it out. So 10.4% rental yield. Awesome. All those other things, we're like, hang on, aren't we just better off getting into a commercial asset and just getting an asset that's 6% net and we're not paying for anything? We know what it's going to do. Not saying that you can't do well in rooming houses. I'm sure there's many people that can. I just looked at it and just went, like, there's a lot of unknowns here. I shouldn't say unknowns. There's a lot of things, like we ran all the financials and you just go, oh yeah, that's a high. Oh yeah, the PM's high. Oh yeah, this is high. Oh yeah, we've got to pay for this. Oh yeah, there's going to be a fuckload of maintenance, yeah, because it's these people living in these places for $200 a week. We went and saw it. The place was kind of a shithole. I'd just much rather, I've got a commercial asset. The commercial asset, I don't hear boo. Rent comes in, I don't hear a thing. It's a 6% net.
When you're checking those financials, are there tenants coming and going or they're staying like for 12 months?
Coming and going. So he's done, coming and going. It's like some people staying there for a month, some people staying there for 3 months.
Okay.
Some people, that one really good thing I think about the asset class, property manager goes in like every couple of weeks.
Yeah.
Because they're like showing new people going in. So it's almost like you're doing inspections every couple of weeks, which I think that's really good. Problem is, if you get a shit property manager, the amount of, like, you think about it, I'm approving, if I was doing the approval of the tenancy, I don't do that anymore. Obviously, we've got Sebastian who runs all this for us. But if you're looking at it, I think you want property to be a pretty passive, asset class. If you're approving fucking tenants every couple of weeks and you've got the property manager messaging you about, this every couple of weeks, because that's what it's going to be. It's 9 different tenants in one asset.
Yeah.
It's a very, very, very active approach to investing. I've got enough shit on my plate. For me personally, I don't necessarily think, okay, cool, I'm happy with that. I would much rather go commercial, which is literally polar opposite, which we'll talk about next.
And I think it's good that we speak about these things here because it's awesome to look at that, and you look at just the dollar signs, but you don't look at what's involved.
Yeah.
And I think as well, when we were looking at that property, because I was with you, the house next door sold for same sort of block, similar size house, but the house needed a reno. It wasn't livable.
Oh, it was a rough house.
Yeah, it was a rough house. Sold for $380.
Yeah.
Okay. And I said, AJ, that house there probably needs $100,000 worth of work, maybe more. Problem is, you get that house up to scratch. Let's just say it's worth $500-600. You got a house that these guys want $900,000. A valuer is going to go in there. The likelihood of the valuer valuing at $900,000 is going to be quite slim as well, which does happen, and we've seen it before happen. I remember the one in Toowoomba. So the valuation doesn't stack up.
Not that we were going to buy the property for $900.
Yeah, I know.
That's what they wanted.
That's what they wanted. So you got to be careful too, because like, let's say it's not, it's not negotiable. You got to buy it for $900. The valuation and the resale, like, would you be able to resell that property? Probably not, because and this is where this is getting a little technical. Imagine you buy a property. Mm-hmm. You turn it into a rooming house, fantastic. So you increase the value because why? You increase the rent. And you've taken it from, let's say you bought a property for $500, but you increase the rent from $500 as well. Say so you buy, let me slow down.
No, you're good.
You buy a house for $500,000, it rents for $500. Yep. You turn it into a rooming house, spend a bit of money on it, whatever you need to do. Then you convert it into a rooming house. The rent goes from $500, let's just say it goes to $1,500, $1,000 a week. Sorry, $1,500 a week. So you increase by $1,000 extra. The value of the property, let's just say, goes to $1 million. Fantastic, okay? Houses in that street aren't selling nowhere near for $1 million, maybe $500,000-600,000. Problem is, you buy that house, the reason why that house is grown in value is not because of the work you've done, it's because it's turned into a rooming house and the rent's gone up. Now, you can't increase the rent anymore because you've maxed out the rent for that market currently.
You've already changed it. Yeah, gotcha.
So if you want to resell that house like in 1 year or 2 years, for like an extra $100,000-200,000 because the market's grown, it won't, because your rent, if your rents, you've already maxed out your rents for that market and that property there, right there and then, your property's not going to grow anymore. It's a bit like commercial.
Yeah, exactly the same.
People listening to this, that's quite important, because I was saying to you, if you buy this property and let's say you want to sell it down the track just for whatever reason, like 2 years down the track, and the rents are still kind of the same, $200 a week, you're probably not going to sell it for. You probably sell for what you paid for it, or you might have to sell for a little bit of a loss, or maybe above, I don't know, depending on the market. But yeah, it's something to be careful about with these houses as well, these rooming houses.
So what you're essentially saying is that if you're in early and you change a house into a rooming house, great, because you're going to get the growth and you're also going to get the rental yield increase. However, getting into a rooming house later, once it's already a rooming house, there's a little bit more added risk to that.
Correct.
Awesome. Yep. Cool. Let's move on from rooming house because we could keep going on about it. Rooming house, I'm almost going to throw duplex, triplex, quadplex, all in the same kind of bundle.
Well, we've already kind of touched on those things.
The next asset class, and again, there's fucking heaps of asset classes. There's farming, there's land
banking,
there's land banking, there's everything. We're just talking about kind of our own portfolio, let's call it, and what's gotten us to pretty successful level. Commercial. Let's talk about commercial. I've got a commercial property. It's a dream. It's fucking cruisy. Wish all my assets, all my tenants, all my property management was like this. But tell me about commercial, when the time is to move into commercial.
So I think it comes down to your position. It's like you went and got into commercial last year or this year?
Last year.
Last year.
What are we in?
We're in 2025, mate. In July.
Where am I? 2025. I think it was this year.
No, I think you settled maybe start of the year, if not end of last year. Or start of the year.
Yep.
So
go for it.
You got into that market. We found a property. I think we paid $750 for that block.
$780.
$780 for that commercial property. 6% net rental yield. All outgoings paid by your tenant. All outgoings paid by your tenant. Nothing for you to pay for except for property management fees.
Yes.
And that's it.
Yeah.
There's a body
1 year guarantee.
There's body corp that's paid. There's a body corp on it, I'm pretty sure, and that's paid by your tenant.
Correct. 1 year guarantee of tenancy.
Or when you bought the property, yes.
So I've got a 1 year, regardless. Still, I don't even know if
So it was a new property that we bought.
brand new.
What was the depreciation on that?
$18,000? Might be wrong. $16,000?
Yeah.
Yeah, it's a high, very high. By far the most.
I thought it would have been higher, but
I think it was about 18.
yeah, okay. There you go.
Maybe 18 or 16.
So depreciation is quite healthy. Where if that was a house, you're probably looking at like 7, maybe 8 grand.
This is a brand new build, obviously.
Yeah, of
that,
course.
That obviously takes a big
And
part
you
of
get
it.
you get a better of course you don't invest in property because of depreciation, but you get a better depreciation fee on commercial than what you do with
Yep.
housing.
Yep.
So you go into that. That's it's a dream. I go into one as well. The purchase price. If I told you, people go, what? Paid
What did you pay for?
310,000.
Yeah.
For a factory.
Yeah.
400 square meters.
Yeah.
And that rents out around $500 a week.
Tenants?
Yeah, tenant. I had a tenant in there, then a tenant left, and I had to get a tenant. It took me about 2 months to get someone.
So that's, again, another little thing that's why I wanted to raise it, right? Tenants are harder to find. When I say harder to find, it takes, depending on the asset type.
If 2 to 3 months, if you get a tenant in, that's quick.
Yep.
That's really quick.
And that's generally tenants
Even
under
4
500K.
Yeah, and if you start looking at like 6 months or 12 months or if not longer to get a tenant in, that's quite long.
But the higher in price point,
The longer it takes to get a tenant.
almost $1 million plus, you've got to kind of expect that six months.
Yeah, of course.
When you go the big whales, $2-3 million, that might take 12 months. However, the benefit of that, once you find the tenant, it is long-term leases. Okay.
Yeah.
And obviously the bigger the asset class, the 3 million, 4 million, 5 million, you're talking 8, 9, 10-year leases, right? That's security. Yes, there is going to be a portion of fear. Oh my God, what's going on? It's been 12 months since we found a tenant, or 6 months since we found a tenant. We're running the asset ourselves. We're holding the asset, paying for all the outgoings, right? It's just something to be considered. And this is almost like we only go in this asset class when ultimately you've go into the next period, correct? So you buy your established properties. If you can buy one of these commercial properties outright, like for a lot of people, it's retirement money, right?
Yeah.
It's like, you run the numbers. You buy 4 assets, you turn $2 million to $4 million in asset value. You sell that entire asset base. You walk away with, I don't know, $1.5 million worth of cash. You buy a $2 million asset, and you put a $1.5 million deposit on that. What can a $2 million asset return you?
Something like that, you might be 50, 60 grand, 70 grand, depending on the rental yield. It all depends on the rental yield. So, if it's, 60 grand if it's 80 grand a year in rent and you got a very small debt, or if you pay that outright, that's 80 grand a year. If it's 100 grand, you get 100 grand, depending on what your loan to value ratio is as well. And
We're
like I
talking a
said,
$1.5 million deposit on a $2 million asset, or a $2 million deposit on
yeah, look, once again, depends on what the yearly rent is on that commercial, but yeah, it ranges. It ranges. So, there's some assets and this is where there's 3 types of assets with commercial. You got retail,
Yep.
office spaces, and industrial.
Yep.
And some of them have higher yields than others, but as well, some have different levels of risk also.
Yep.
But also, there's types of assets as well. If it's saturated, for example, like let's say in Melbourne, factories, there's a lot of them and people want them. And of course, the rental yield, they're in high demand, but the rental yields aren't like 6 or 7 or 8%
Gotcha. Rental
yields, where if you go to other areas around the country, you could probably get that. So a lot in Vic, you probably get a 4 or a 5% rental yield. So when you look at that and you buy $2 million at 4%, it's not really great. But if you go into a different state or different location, you probably get a 6 or a 7. So that's where if you got to be a bit strategic. And I think I don't like office space. I think they're one of the most dangerous commercial assets you can have, especially with AI and everything coming in now and everyone working from home. Retail can be people. There is levels of risk to that as well, but they can be quite safe in certain areas. And when I say certain areas, you look at regional towns, there's heaps of retail. You look at, and if you look at it, they're not really affected from technology and different industries and bigger corporations compared to like Melbourne and Sydney.
Gotcha.
So if you go into retail into like, let's say Townsville, and you buy a shop front, or you have a shop front with 2 or 3, rents coming off it because maybe it's got a house at the back or two dwellings at the back, that's quite safe as well. So retail, there is some level of risk, but of course you've got to be quite careful of where the location is and the type of asset. Industrial is the safest, factories and things like that, industrial estates, and they're quite high demand at the moment in certain areas, so which is great, and you get a tenant pretty quick in some of the areas, anywhere from 3 months roughly. But I also like going into retail, but if you're going to get a multi-dwelling, so for example, we know people that have bought, big shopping complexes, or one of our friends, Christina, she's got, I think she got four leases coming off it. So it's retail. It's got like a gym. It's got, I think one's like a pet barn and something like that.
Yep.
And I think, when you look at a property that's got 4 leases, 1 leaves, you still got 3 coming in. It's like a multi-tenant block
like
unit.
a duplex, quadplex.
Yeah,
It's the exact
so
same thing.
I like them a lot. I think if you go for the big, in
Megalodon.
like a factory or something like that, it's going to be rented out, or a big retail space like a Office Works or some of that. That's great, but there is a level of risk there if they leave. Then you got to find a big tenant to come in and take that property. Where if you've got multi dwellings, I look at it as a little bit more safer, and I like that as well. But if you go for a factory around that $1 million price point, they're always going to be tenanted, and find a tenant pretty quick and easy in those areas as well.
Yep, love it. I mean, we could keep going on. I think for the most part, and tell me if I'm wrong, that will be the way that you retire. When I say retire, hit your income goal from your portfolio. Will it be mostly those commercials, mostly those
That's where I want to end up. And there's things you can do commercial where commercial, the growth isn't really as strong. It does grow if you buy correctly, but you can also do manufacturing. So if you buy a property, I remember Austin was looking at this one in Coffs Harbour for a client, 1.2 mil, but the rental yield was around 5%, and it could increase to a 7%. Okay, so once you do that to a property, you can increase the growth on the property too. So if you increase your rent, the value of the property grows in commercial. So you can do the same thing with commercial, increase the value by doing things like that, as well increase the value by, if you put a mezzanine floor into the property, you increase the footage, the square footage.
Yep.
So there's more space, and then people can, you get more rent as well. So little things like that, but that's where you want to end. There's daycare centers and stuff like that. They're safe, and they're always going to be a tenant in there as well. So there's certain types of assets you want to get into. Medical's quite safe as well. Petrol stations and stuff like that, you probably be careful with what's going on with EVs and stuff like that. Of course, it's probably going to be a long time until there's no petrol, but it's just still like you probably got there's probably better assets there with lower risk that you can get into.
Yep. And I want for the viewer just to hear, because you're talking about very, very, very different things compared to your standard residential property, right? You're talking about EV and this, and it is a business.
Correct.
So commercial, I mean, obviously...
Are you targeting a business owner?
Well, yeah, but I just want to highlight what you're saying, right? The level of due diligence on a commercial asset is very, very different from a residential asset. Not to say that there's not risk with both, right? But people buying commercial assets, even our clients buy commercial assets, you need to be pretty sophisticated. And when I say pretty sophisticated, you need to understand the risks of resi. I think you need to be really comfortable with the property taking longer than a week to get rented out. But you also need to have a different lens of what you're looking into to identify risk, to be comfortable with risk. Even for myself, buying that commercial asset, it was a very, very, very different process. Very different process. It taking 3-4 months to be rented out, like that. Like if I'm fucking stressing out and whatnot, don't get into it. Genuinely, I'm genuinely saying that.
I think it's a good point you bring up. So if you're getting into commercial, and this is where if a client's got 500 grand to spend, I don't say, just let's go in commercial and that's it. You got to have money on the side to
100%.
Holding costs.
100%.
Because there's going to be times like you might get a tenant in there from day one, fantastic, on a 2-3 year lease, maybe more. But if there is no tenant, you're going to have to hold that property probably up to 3 to 4 months if you buy correctly. Depending, if you buy correctly, 3 to 4 months, maybe longer, but you're going to have to wear that. So if you buy a property at $1 million and you've got a loan of 800 grand or 700 grand, it's a bit of money coming out of your pocket.
Yeah.
A bit of money coming out of your pocket. So you just got to make sure you can hold those costs.
For sure. And this is kind of why, I mean, my strategy, and this is where I think you and I differ a little bit potentially, maybe not. My strategy is buy as many resi properties as I possibly can. Obviously, we're now starting to move into that space, but here's the benefit of me having this commercial property right now. It's not costing me 15 grand. It still costs me, I think, 3 grand, probably a 3 grand a year, which is great. What's better is that when it comes time that I sell 3-4 assets, I then go and buy $1 million or $1.5 million commercial property outright. That is like, I mean, for me, I've got a goal, hit 200K. If I buy an asset $2 million or $1.5 million and is bringing in 70, 80, $100,000, I mean, that gets me a lot closer to that. That for me is security. Buying an asset now, I might look at this, buying my commercial asset, I might look at it and go, well, fuck, maybe that was a mistake because I'm not going to get the same level of growth. I might, not as guaranteed as what the resi property is. And it's not really having an impact on my life, right? I'm going from negative 10, 15 to negative 3. So I might look at this strategy of now already moving into commercial potentially and go, well, that was probably a mistake. Maybe, I don't know. We're playing the game. So it's going to be interesting. I think people need to, even with the duplexes and you saying like, oh, you could buy it right off the bat. Well, it's hard to find. You could go and buy a commercial property right off the bat, but hang on, you've got to pay for all those outgoings at the start. I think what's super important, and how we coach our clients, you buy your resis, you sell them down, you then move into those cash flow assets. Again, people have different beliefs. Even you and I kind of go back and forth on this. I think it's a lot simpler, a lot easier, and you are going to see the real benefits of those cash flows when you're buying something outright, which is obviously going to be possible if you're buying 3, 4, 5 assets that double in value in a 5-6 year period.
Of course.
Yeah.
Definitely. This has been good. I think there's a lot here we've spoken about. How long have we been going for?
51 minutes.
Holy shit, Kate.
So there you go.
It's the ambience of this house. No, it's a good session. Just to recap, so going over everything, units, apartments, townhouses, you can still buy them correctly, but...
What's the time?
Do you have your phone on you?
What time you got to run?
What time is it?
Almost 10.
Okay,
You got a meeting at 10?
Yeah, that's fine.
It's 9:58. Let's finish it up. Frank's got a meeting and we're fucking stressing out. Frank's got a meeting. Let's finish it up. Units, apartments, townhouses, under 400K, go. Houses, simple, easy, less risk. Duplexes, quadplexes, triplexes.
Blocks of units.
Next asset class. And then we have commercial, the mother load. Finish. We'll see you next episode. Go to your meeting. Thank you very much.
Thank you, guys.
Bye-bye.